Ever feel totally lost when the news talks about money moving around the world, currencies going up, currencies going down? You probably just think stronger is better.
Right, that's a natural assumption.
Especially when you hear about things like new tariffs or accusations that countries are somehow fiddling with their money.
Right.
Well, that's exactly what we're diving into today. Our mission is to tackle a question that sounds completely upside down. Why would a country actually want its currency to be weaker?
It does sound strange at first glance, absolutely.
Right.
We've looked at the information you shared, which, yeah, it touches on some pretty current events,
Mm-hmm.
and it really highlights a key puzzle in how countries interact economically. So we're going to try and solve this puzzle of why a weaker currency might be, well, desirable.
Okay.
And maybe start by just making sure we're on the same page with some basic terms. There are a few important ideas we need to get clear on right away.
Okay, let's unpack this. The terms devaluation and depreciation keep popping up. They both sound like the currency loses value, but the information suggests they're not quite the same thing. What's the core difference for someone just trying to get their head around this?
That's a great starting point.
Yeah.
Yeah, the result might look similar. The currency ends up being worth less compared to others, but what causes it is the key.
Hmm.
Think of it this way. Currency devaluation. It's like a country's government making a deliberate decision,
Okay.
a conscious choice to lower the price tag on its money, so to speak. They're actively choosing to make it weaker.
Okay, so that's a conscious push by the government. What then is depreciation if it's not deliberate?
Currency depreciation, on the other hand, is more like a natural shift. It happens when a currency loses value because of, say, how the economy is doing overall,
Uh,
or maybe if investors start to lose faith in that country's economy and decide to sell off its currency. It's driven more by market forces, supply and demand, investor confidence.
Not a direct government action.
Exactly. Not a direct decision by the government. Think of it maybe like a company's stock price going down because, I don't know, people aren't buying its products as much. It's the market reacting.
Got it. Devaluation is a deliberate push downwards. Depreciation is more of a natural slide. Now, the sources also mention currency manipulation. How does that fit into this picture? Is that the same as devaluation?
Not exactly, though they can be related. Currency manipulation is when a government actively tries to control or significantly influence the value of its currency over time.
Okay.
Now, and this is important, not every time a country adjusts its currency or manages its exchange rate is considered manipulation. Many countries, especially those that sell a lot of goods overseas,
Exporters.
yeah, major exporters, they actually manage their exchange rates as a kind of normal part of their economic plan, just to stay competitive.
So, managing your currency isn't automatically like cheating then. When does it become controversial and get that manipulator label thrown around?
It usually becomes controversial, and that currency manipulator label often gets used when a country isn't really open about what they're doing.
Ah, transparency.
Right. Or if it seems like they're intentionally forcing their currency down to an unfairly low level for a long time. The argument is that this makes their products sold to other countries artificially cheap, giving them an unfair advantage in trade.
I see.
But, as the sources point out, currency manipulator is often more of a political term than a strictly defined economic one with, clear rules everyone agrees on.
Right. It sounds like there's quite a bit of gray area. Okay, so we've got devaluation, that's the government's choice, depreciation, market forces doing their thing, and manipulation, active government influence that might be seen as unfair.
Hmm.
But we started with that big question for anyone new to this. Isn't a strong currency always better? Why in the world would a country intentionally make its money weaker? Here's where it gets really interesting.
Exactly. When you first hear it, it sounds completely backwards. Why make your money worth less? But in the world of how economies work on a big global scale, a weaker currency can actually be a pretty powerful tool.
How so?
Well, the main reason, the biggest one really, is making a country's products cheaper for people in other countries to buy, boosting exports.
Cheaper exports. Can you give us a simple, maybe a real world type example of how that actually plays out?
Okay, let's imagine a simple case like that toy factory example in one of your sources. Let's say normally $1 buys 7 Chinese yuan.
Right. Okay, $1 equals 7 yuan. Got it.
So if that factory sells a toy for 70 yuan, someone in America would pay $1 to buy it. Simple enough. Now, what if the U.S. puts a tax, say a 30% tariff, on toys coming from China, like we saw discussed in those 2025 scenarios.
Right. So that toy suddenly costs more.
Yeah, that same toy would now cost the American buyer $1.30, the original dollar, plus 30 cents tax. That makes it less appealing, obviously.
Ouch, yeah, a 30% price jump is significant. So how does a weaker currency help the toy factory here?
Okay, now imagine China deliberately weakens its currency. Let's say they make it so that $1 can now buy 8 yuan instead of 7.
Okay, the yuan is weaker.
Right, that toy still costs the factory 7 yuan to make.
Yeah.
But when that 7 yuan is converted back into US dollars at the new rate, well, 7 divided by 8, it now only costs about 88 cents in US currency.
Ah.
So even after you add that 30% US tariff onto the 88 cents, the final price is around $1.15. It's still more expensive than the original dollar, sure, but it's significantly cheaper than the $1.30 it would have been without the currency weakening.
That makes perfect sense. It's like the weaker currency acts as a cushion, absorbing some of the tariffs impact.
Exactly. The Chinese factory can keep its prices more competitive in the U.S. market without having to slash its own costs or profits quite as much.
The source did mention, though, that these devaluations are usually small and happen gradually, not like a big jump like in our example. Why is that?
That's a really good point.
Yeah.
Sudden large devaluations can create panic and instability in the economy. They can really shake confidence.
Okay.
But even small, gradual adjustments can have a really big effect because of the sheer volume of international trade. We're talking trillions of dollars worth of goods and services crossing borders every year.
Right.
So even a small percentage change in the exchange rate can add up to a huge difference in the final prices when you multiply it across all that trade. And like the sources noted, you often hear complaints from U.S. companies that export, saying a really strong dollar makes their goods too expensive for buyers overseas.
Okay, so cheaper exports is a major reason. What's the second advantage of a weaker currency? The sources mentioned something called invisible tariffs. How does that work?
Yes, a weaker currency essentially makes goods coming into your country from other places more expensive.
The flip side.
Exactly, the flip side. Think about it. If your country's money isn't worth as much compared to, say, the euro or the dollar, you'll need to spend more of your own currency to buy the same imported goods.
Right. That laptop from overseas just got pricier?
Precisely. This has a similar effect to putting actual taxes or tariffs on imports. It makes products made within your own country look relatively cheaper and therefore more attractive to local shoppers.
Interesting. So it's like putting up a barrier to imports without actually imposing a formal tax that everyone sees and might complain about.
You got it. And this can sometimes be seen as a less confrontational way for a country to support its own industries compared to slapping on tariffs. Tariffs often lead to retaliation, right? Other countries put taxes on your goods in return.
Sparking trade wars.
Exactly, like the one mentioned between the U.S. and China. So weakening the currency can sometimes achieve a similar outcome, maybe without provoking the same immediate backlash.
But there's a catch, right? Like tariffs. Doesn't this also push up prices for consumers?
Yes, absolutely. Just like with tariffs, making imports more expensive through a weaker currency can definitely contribute to inflation. People end up paying more for those imported goods, whether it's electronics or food or fuel.
That makes sense. It sounds like a bit of a balancing act. Definitely has potential downsides.
Right.
What's the third reason a country might want a weaker currency? Something about making debt easier to handle. This one sounds a bit sneaky.
Huh. Well, it can be. But this one is a bit more complicated, and it only applies to debt that a country owes in its own currency.
Okay, only domestic debt.
Right. Imagine a made-up country, wee land, as your source described it. Let's say the wee land government borrowed, I don't know, $1 million wee dollars from its own citizens by selling bonds.
Okay.
Now, later on, the government takes actions that cause the wee dollar to weaken, and this leads to inflation prices going up across wee there.
Right.
When the time comes for the government to pay back that $1 million wee dollars, those $1 million simply don't buy as much stuff as they did when the money was originally borrowed,
Right.
because prices have gone up.
I get it. The number of dollars is the same, 1 million, but the actual value or purchasing power of that million has gone down because of inflation.
Exactly. So in real terms, the burden of the debt has shrunk.
Yeah.
The government is paying back money that's worth less.
But the source also warned that this trick doesn't work for debt that's owed in a different currency, like US dollars. Why not?
That's a crucial point, really important to understand. If a country, let's say wee land, again, has borrowed money in US dollars, and then its own currency, the wee dollar, weakens, Well, now it becomes more expensive to pay back that foreign debt
How so?
because they need to use more of their now weaker wee dollars to buy the same amount of the stronger U.S. dollars needed to make the loan payment. So weakening your currency when you owe money abroad actually makes your debt problem worse, not better.
Wow, okay, so that debt reduction trick is very specific only for debt in your own currency, and it relies on generating some inflation, which has its own problems.
Precisely. It's definitely not a free lunch.
Okay, so we understand the why, cheaper exports, making imports pricier, like invisible tariffs, and maybe easing the burden of domestic debt. Now, how do countries actually do this? How do they make their currency weaker? It's not like they can just flip a switch, right?
Not at all. They have several tools they can use, and these are often wielded by their central bank, which, as your source correctly points out, is usually independent or supposed to be independent from the main government.
Okay, central banks. What's tool number one?
One key method is cutting interest rates.
Interest rates. Okay, I hear about those all the time, but how do lower interest rates lead to a weaker currency? That link isn't immediately obvious to me.
Think about it from the perspective of someone with money to invest, a big international investor maybe. When a country has high interest rates, it becomes more attractive for them to park their money there.
To get a good return.
Exactly.
Yeah.
They might buy government bonds or just hold money in savings accounts in that country to earn those higher returns. To do that, they first need to buy that country's currency.
Ah, increasing demand for it.
Precisely. More demand for the currency tends to push its value up, making it stronger. Now, flip that. If a country cuts its interest rates,
Less attractive for investors.
right, those investments suddenly look less appealing compared to what they could earn elsewhere. So investors might decide to sell off their bonds and, importantly, sell off that country's currency to move their money to countries offering higher returns.
So selling the currency.
Leads to less demand or even increased supply of it on the market, causing its value to fall. It weakens. It's sort of like capital flowing out because the returns aren't as good anymore.
Okay, that makes sense. Lower interest rates make holding the currency less appealing to global investors, so they sell it. What's the second method they can use?
The source mentioned printing more money, sometimes called quantitative easing or QE. That definitely sounds like it would make money worth less.
It certainly can. Quantitative easing, or QE, is a bit more technical, but basically, the central bank creates new money, usually electronically, not literally printing presses these days.
And uses this new money to buy assets, typically government bonds, from commercial banks.
Okay, so the central bank is injecting money into the banking system.
Yes. This increases the overall money supply floating around in the economy. And basic economics tells us that when there's more money chasing the same amount of goods and services, prices tend to rise. That's inflation.
And inflation means each dollar or yuan or whatever buys less.
Exactly. As the value of each individual unit of currency goes down, because things cost more domestically, the currency effectively becomes weaker when compared to other currencies where inflation might be lower.
Got it. So increasing the money supply dilutes the value of the currency already out there? What's the third way mentioned? Something about using foreign reserves?
Yeah, this is another direct tool. Many central banks hold big stockpiles of foreign currencies, often major ones like the US dollar or the euro. These are called foreign reserves.
Great.
They can actively buy or sell their own currency in the foreign exchange market using these reserves to directly influence its price.
How would that work to weaken it?
Well, say a country like China wants to weaken its currency, the yuan. Its central bank could go into the market and sell large amounts of yuan and use the proceeds to buy, say, US dollars to add to its reserves.
Selling yuan increases the supply.
Exactly. Increasing the supply of yuan on the market while simultaneously increasing the demand for dollars tends to push the value of the yuan down relative to the dollar, makes it weaker.
The source mentioned China setting a daily target rate or a band for the yuan. How do reserves help with that?
Right. China uses what's called a managed float system. This means they let market forces influence the yuan's value day to day, but only within a certain range or band that they set.
So
If the market starts pushing the yuan too high, getting too strong, the central bank might step in and sell yuan, buying foreign currency like dollars, to nudge it back down into the desired range.
and if it falls too low, too weak.
Conversely, if the yuan starts falling too quickly or too far, they can use their large reserves of US dollars to buy back yuan from the market. This increases demand for the yuan and helps support its price, pushing it back up.
So they can use reserves to both weaken and strengthen it to keep it in that band.
Yes, although, as the source pointed out, Trying to strengthen your currency this way, by buying it back using foreign reserves, can be quite expensive. You can burn through those reserves quickly if the market pressure is really strong.
Makes sense. And this is different from how the US dollar
But
works.
generally, yes. The US dollar operates more on a free float system. Its value is primarily determined by supply and demand in the global market, with much less direct day-to-day intervention by the US government or the Federal Reserve compared to a managed flow like China's.
Fascinating. So countries have these tools, interest rates, printing money, using reserves to try and nudge their currency's value around. But this naturally leads back to that question of fairness. Is this all just, a form of economic gamesmanship? Is it cheating?
That's the million-dollar question, isn't it? Or maybe the million-yuan question here. It's really contentious.
Yeah.
As your source highlighted, the U.S. actually labeled China a currency manipulator back in 2019 when the yuan weakened past that 7 per dollar mark, largely suspecting it was a deliberate move to offset U.S. tariffs.
I remember that.
China denied it, of course. And interestingly, the U.S. didn't actually impose any specific penalties because of that label, and they removed it fairly quickly afterwards.
Huh.
It really shows how calling someone a manipulator is often driven by politics and trade tensions as much as by strict economic definitions.
Yeah.
It depends heavily on who's looking and what their interests are.
It sounds like it's often a matter of perspective then. The source also brought up something called the Plaza Accord back in 1985. That was kind of the opposite situation, wasn't it? The U.S. actually wanted the dollar to become weaker.
Exactly. That's a classic example. Back then, the U.S. dollar was incredibly strong, and the U.S. was running huge trade deficits, buying way more from countries like Japan and Germany than it was selling to them.
So imports were flooding in.
Right. So the U.S. put pressure on the other major economies, Japan, West Germany, France, and the UK, to get together and agree to intentionally weaken the U.S. dollar against their currencies
And how did they do that?
through coordinated intervention in the currency markets. They agreed to sell U.S. dollars from their reserves and buy up their own currencies. For instance, the Bank of Japan sold dollars and bought yen.
Increasing the supply of dollars, increasing demand for yen.
Exactly. This pushed the dollar's value down significantly, and currencies like the Japanese yen and the German Deutschmark shot up.
And the source mentioned this had some pretty serious unintended consequences, especially for Japan.
Yes, it's often cited as a major turning point for Japan. The yen strengthened so much, so quickly, that it made Japanese exports suddenly very expensive. This hurt their export-driven economy quite badly.
Okay.
To try and counteract this slowdown, the Bank of Japan slashed interest rates really low and encouraged lots of borrowing. This fueled a massive speculative bubble in asset prices stocks, real estate in the late 1980s.
The infamous Japanese bubble economy.
That's the one.
Yeah.
And when that bubble inevitably burst around 1990, it triggered a long period of economic stagnation for Japan, often called the lost decades, which they arguably struggled with for a very long time.
Wow. So it's a real cautionary tale about how deliberately messing with currency values, even with international agreement, can backfire badly.
Absolutely. It shows the potential for serious knock-on effects that are hard to predict or control.
The source also mentioned something called a currency war popping up after the big financial crisis in 2008. What was that about? Sounds dramatic.
It was a period of heightened tension. After the 2008 global financial crisis, economies everywhere were struggling. Growth was slow, unemployment was high.
Right.
So many countries started trying to boost their own economies by making their exports cheaper,
Ow.
by using the tools we discussed, cutting interest rates very low, engaging in quantitative easing, essentially allowing or even encouraging their currencies to weaken.
So everyone was trying to get an edge by having a weaker currency.
Pretty much. It became a kind of unspoken competition where countries were trying to devalue their way to recovery, hence the term currency war. Brazil's finance minister actually coined the phrase back then.
What's the danger if everyone tries to do that at once?
Well, if too many major economies are all trying to weaken their currencies simultaneously, it can create a lot of problems. First, it doesn't really work if everyone does it. You can't all devalue against each other effectively. Second, it can export inflation around the world. It can also lead to instability and panic in financial markets and seriously damage trust and cooperation between trading partners. It risks a sort of race to the bottom.
So while one country might see a temporary advantage in weakening its currency, if everyone piles in, it can destabilize the whole global system. It really sounds like whether weakening a currency is seen as fair or unfair is very subjective.
It really is. One country might frame it as a necessary defensive measure to protect domestic jobs and industries.
Well,
Another country, maybe one whose currency is strengthening as a result, might see it as predatory, unfair competition designed to steal growth.
depends on which side of the trade flow you're on.
Largely, yes. And as the currency war idea suggests, widespread competitive devaluations are probably harmful for the global economy as a whole.
Okay, so we've looked at the why and the how and the tricky question of fairness. But the last piece of this puzzle, which we touched on a bit, is the potential downsides for the country itself. Is having a weaker currency always a net positive, even if you achieve your goals?
No, definitely not. It comes with some significant potential drawbacks. The most immediate, and maybe most widely felt one, is usually inflation.
Right, prices going up.
Exactly. As we discussed with the invisible tariff idea, a weaker currency makes imported goods more expensive. Think about things people buy regularly: food, oil for energy and transport, electronics.
Things that often come from abroad.
Precisely. If a country relies heavily on importing these essentials, a weaker currency directly translates into a higher cost of living for its citizens. Prices go up on the shelves.
The source mentioned that countries like Turkey might be particularly vulnerable to this. Why would that be the case compared to, say, China?
It often comes down to the structure of the economy. A country like Turkey might import a larger share of its energy or certain types of food or components for its manufacturing sector. If so, a fall in its currency's value will feed through into domestic prices much more quickly and intensely.
Okay.
A country like China, while a huge trader, also has a massive domestic production base. It might produce more of its own food or have domestic energy sources or make more components locally. So while it's not immune, the inflationary impact from a weaker currency might be somewhat less severe or at least offset by the benefits to its vast export sector. It really depends on that reliance on imports.
So it hits harder if you need to buy a lot from overseas. What's another downside? The source mentioned it can eat your salary. What does that mean in practice?
It means exactly what it sounds like. If the cost of living is rising because of this inflation, maybe your grocery bill is higher, gas costs more, that new phone is pricier, but your wages, your salary, isn't keeping pace.
Your money doesn't go as far.
Exactly. Your purchasing power erodes. You might be earning the same nominal amount of money, but you can buy less with it. This can lead to a real decline in living standards for ordinary people, especially if wage growth is slow.
That sounds like it could also feed into another problem mentioned, widening inequality. How does a weaker currency do that?
Well, think about how different people react to inflation. When prices are rising and cash is losing value, people with savings or wealth often try to protect it by investing in assets they think will hold or increase their value.
Like real estate or stocks.
Exactly. Things like property, stocks, maybe gold. As more money flows into these assets trying to escape inflation, their prices can get bid up rapidly.
Creating asset bubbles,
Yeah.
potentially.
Potentially, yes. But the key point for inequality is who owns these assets. Generally, it's the wealthier segments of society. So they might see the value of their assets go up, protecting or even increasing their wealth.
Meanwhile,
Meanwhile, people who rely mostly on their wages, especially those on lower or fixed incomes, are just hit by the rising cost of necessities. They don't have the same ability to buy assets to protect themselves. In fact, rising asset prices, like housing, might make it even harder for them to get ahead. So the gap between asset owners and wage earners can widen.
that's a really sobering potential consequence. And finally, the source cautioned that a country can't just keep weakening its currency indefinitely. What's the ultimate danger if they push it too far, too often?
The biggest long-term risk is really fundamental. It's a loss of trust in the currency itself.
Trust.
Yeah. If a government or central bank gets a reputation for constantly weakening its currency, leading to persistently high or unpredictable inflation, people just lose faith in it, both the citizens living in that country and international investors.
They stop believing it will hold its value.
Exactly. If people think the money in their pocket today will be worth significantly less tomorrow, they'll try to get rid of it quickly, maybe by buying goods immediately or trying to exchange it for a more stable foreign currency or for assets. If this loss of confidence becomes widespread, the currency can spiral downwards and potentially become almost worthless. Think of historical examples of hyperinflation.
Right. Leading to complete economic chaos.
It can in extreme cases. It undermines the entire basis of the economy if people can't trust the money.
So it sounds like it's a very, very delicate balancing act. A weaker currency can offer some real advantages, especially for exporters, but it comes packaged with some pretty serious risks: inflation, hurting wages, inequality, and ultimately the risk of destroying confidence in the money itself.
That sums it up pretty well. It's a tool in the economic policy toolkit.
Mhm.
And as we've seen from the sources, countries like China, Japan, even places like Switzerland have used strategies involving currency weakening at various times. But it's absolutely not a simple fix. And whether it works out beneficially depends hugely on the specific context, how well it's managed, and frankly, who bears the costs.
Okay, so just to quickly recap for everyone. We've seen that weakening a country's currency, while sounding weird at first, can make its exports cheaper and more competitive internationally. That helps businesses selling overseas.
Hmm.
It can also make imported goods more expensive, acting like an invisible tariff, potentially encouraging people to buy locally produced things.
Right.
And in very specific cases, debt owed only in its own currency, it can make government debt seem a bit easier to manage by letting inflation reduce its real value.
Correct.
But, and this is a big but, the downsides are significant. It can fuel inflation, making everyday goods pricier. It can eat away at the purchasing power of people's salaries if wages don't keep up.
Yeah.
It can potentially worsen the gap between the rich, who own assets, and the poor, who rely on wages. And if taken too far or managed badly, it can lead to a total loss of trust in the currency, which is disastrous.
Exactly. It's a powerful tool, but one with sharp edges. Its effectiveness and fairness are constantly debated by economists and policymakers.
So maybe it's not always a simple choice between just wanting a strong currency or a weak one. Perhaps the real question is more about who's actually pulling the levers of monetary policy and who ends up feeling the pinch or maybe the benefit in their own pocketbook.
That's a very good way to put it. It's often about those distributional effects.
Definitely something to think about the next time you see those headlines about currencies moving up or down. Thanks for breaking this all down with us today.
My pleasure. It's a complex topic, but hopefully that makes a bit more sense now.